I'm going to start sharing our content with you. And you should be able to see, right now you're seeing the cash budget, but we're going to be going over problem 22-05B. And we're going to be looking at today a budgeted income statement and a balance sheet. And I would like to say to you before we get started that on the budgeted balance sheet for the cash account, you're probably not going to understand how to get the amount yet. And the reason for that is because we skipped a couple of chapters in this textbook, and we haven't covered how to do what is called a statement of cash flow. We did touch on it in ACC120 for a little bit, but you really need more instruction on that statement of cash flow. So I have given you the amounts that you would plug in for your cash account. They are on your previous announcements for this course. They should be on your announcements. So if you want to look back through your announcements, you'll be able to see what the cash amount is and also the retained earnings amount is. So the rest of it is should be pretty much familiar to you. We're going to start with our budgeting income statement. And this is a multi-step income statement that you'll be preparing. And it is a budget, so these are projected figures that the company is going to be working with. And from your sales budget, you would get the sales information. But in this particular problem, they didn't ask you to prepare a sales budget. So they've given you the amount of units that you are to be selling, and they've given you a selling price. So if you look at your information that they've given you for this problem, if you'll go back down to the middle of the problem where it tells you that the factory output and the sales for 2000 Y8 are expected to total 3,800 units, which are to be sold at $120 a piece. So that 3,800 units is going to be multiplied by the selling price per unit to get the amount of the sales. So we're simply going to multiply 3,800 times the selling price of $120, and both of these are given in your problem. So the total amount of the sales for this period of time would be plugged into your budgeted income statement of $456,000. For your cost of goods sold, the cost of goods sold is going to be basically the cost of your goods that have been manufactured. And if you'll notice in your information, they have estimated cost and expenses that are given to you for the cost of goods manufactured. And they're going to be made up of direct materials, direct labor, and factory overhead. So on your cost of goods sold portion of the budgeted income statement, your titles are going to be direct materials, direct labor, and factory overhead. These are the cost of the manufacture of the product, and that's what you're going to put in for your titles that go under cost of goods sold. Now you are going to have to determine the amount to put in for each one of these manufacturing costs. And for your direct materials, what you need to know is that direct materials has been given to you as a variable cost per unit sold. Notice in your instructions here, they tell you the variable cost of the unit sold is $30 per unit. Now, we were given that we have sold 3,800 units of product. That came from our information for our product. It was a given amount. And so we're going to simply multiply 3,800 times $30. And that will give us the amount of the direct materials for this period of time, which is $114,000. Remember that direct materials is what we consider to be a variable cost. And if it's a variable cost, we've got to multiply the variable cost per unit times the number of units sold, which is $3,800. That's how I got the amount for the direct materials. You will do the very same thing for your direct labor. It would be $8.40 is the amount of your direct labor per unit that you sold. You would multiply that by the 3,800 units that were given units that were sold, and that will give you 31,920 that goes in for the direct labor. Again, your direct labor is a variable cost. For your factory overhead, you have two separate accounts for factory overhead that are in this particular problem. One of those is depreciation of plant and equipment, and the other one is for your factory overhead. Notice your depreciation of plant and equipment is in the fixed column, and this means that we're not going to have to multiply it by the units sold. We're just going to take the amount of the fixed cost, and that would be the amount of the depreciation for the plant and equipment, and that becomes a part of the factory overhead. We also have other factory overhead that's going to be a part of factory overhead. Notice the other factory overhead is what we call a mixed cost. So it's part variable and it's part fixed. The part fixed is the constant part of $1,400, but the variable cost for other factory overhead, you will have to calculate it, and it's based on the variable rate times the number of units sold. So what we're going to do is we're going to calculate our variable cost first. Not that you have to, but it's just easier to do that since there was one variable cost per unit for the other factory overhead. Let's take that $4.80 and multiply it by the total sales units, and the total sales units were given to us at 3,800 units. So we are multiplying 4.8 times 3,800 units, and that will give us 18,240. That would be our other factory overhead variable cost portion. So it's $4.80 times 3,800. That's how I got 18,240. Then to get the remaining factory overhead, excuse me, class, you're going to simply add the fixed cost portion to your variable cost portion. So we're going to combine with the 18,240 the fixed cost of both of these factory overhead accounts. And when we add both of those together, it's going to give us a total amount for our factory overhead at 23,640. Do you understand how we got the cost of goods sold amounts? Since I hear no questions, we're going to go ahead and add the total of each one of the materials, labor, and overhead together to get the total cost of goods sold. Your total cost of goods sold is 169,560. That was the total of each one of the manufacturing costs added together. All of this combined is 169,560. You're going to take your sales then of 456,000. We're going to subtract out the cost of goods sold of 169,560, and that's going to give us 286,440. And just like in your other income statements, your cost of goods sold is going to be what you have left, or excuse me, your gross profit is going to be what you have left to cover your operating expenses. Notice they've started with the selling expense first, and so you'll need to determine what are your selling expenses. So we're going to back up to our information, and you can see here that our selling expenses are going to consist of your sales salary and commissions, your advertising, and your miscellaneous selling expense. And these are your account titles, and then we're going to figure out each of the amounts separately for these selling expenses. Your sales salary and commissions is a mixed account. You can see here that it's got part variable and part fixed in it. So what you need to do is I would calculate my variable cost first, and to find variable cost, we'd take the 1350. That's the variable cost per unit, and we're going to multiply this by the number of units sold. The units sold were 3,800 units. That was given in the problem. And then we're going to add to this variable portion of our sales, salaries, and commissions expense. We're going to add to it the fixed part. So this 12,800 is your sales salaries portion. That's the fixed portion. And we're going to add that to the 51,350. And so your total expenses for your sales, salaries, and commissions is 64,100. Your advertising expense is a fixed cost. There was no variable portion, so we just bring down the 13,200 and plug that in for advertising. Now your miscellaneous selling expense is part variable and part fixed. So find the variable portion first, which is the variable cost per unit, $2.50, times the number of units sold, which was given to you at 3,800. This will give you $9,500 for the variable portion of your miscellaneous administrative expense. You're going to need to add to that the fixed portion of $1,000, and your total miscellaneous selling expense is $10,500. Then you're going to combine all of your selling expenses together. And all of this combined is 87,800. For your administrative expenses, they have given us a list of administrative expenses, their office and officer salaries, your supplies, and your miscellaneous administrative expense. Once you have your categories, we're going to determine the amount first of our office and officers' salaries. And you can see here that they had some that were variable cost. So again, we're going to multiply our $7. Let me clear this out. Multiply $7 times the number of units, which is 3,800, the units sold, and so that gives you the variable cost portion of this as office and officer salaries. Then you're going to add your fixed portion to that of 7,800. So the total amount is $34,400. Our supplies, the variable portion is $1.20 per unit. And we're going to multiply this by the 3,800 units. Our variable cost portion of our supplies is $4,560, and then we have to add the fixed cost portion to this, and that will give you $5,060. For your miscellaneous administrative expense, it too is both fixed and variable. So find your variable first. $2.40 times the number of units sold, which was 3,800 units. And then you're going to add back in your portion to that, which was 400 for the miscellaneous administrative expense. And that will give you 9520. Then we're going to determine our total administrative expenses. We're going to add these three together. And that gives you a total total administrative expense of $48,980. Then you're going to find your total operating expenses, which is the total of your selling expenses plus the total of your administrative expenses. The next thing we need to determine is what we call the income before income tax amount. And to find that, we're going to take our gross profit and we're going to subtract our operating expenses from it. Now, it used to be that we called this the operating income, but because this is a corporate form of business, corporations have to pay income taxes. So the title is going to change here to income before income taxes. So I'm going to put in my gross profit in my calculator of $286,440. I'm going to subtract out the total operating expenses of $136,780, and the total is going to be your income before income taxes. Again, I'm getting this amount by taking my total administrative expenses and subtracting it from my cost of goods sold. That leaves me with my income before income tax. The next thing we would need to calculate is our actual income tax expense. So I'm going to look to see if they gave us some information about the income tax expense. And if you look in your additional information at the beginning of the problem, you can see in the very last paragraph that they've given you the federal income tax of $35,000. Then you're going to subtract the difference between the income tax and the income before tax, and that's going to give you the amount of your net income. So I'm going to back out 35,000 from my income before income tax, and the amount will be 114,660. Can you hear me okay, class? I'm not getting any response, so I'm assuming you can. Is there? Yes, I hear somebody speaking. I can't understand what you said, but I'm assuming that you said yes. The budgeted income statement. Go ahead. Can you ask the question? I hear a lot of feedback, so one at a time, please. I don't hear any questions. So I'm assuming you understand what I've done so far. We'll move on to the budgeted balance sheet. And in a balance sheet, we always start with our asset section first. Our current assets would be listed first because they are the most liquid assets, and we will always begin with cash. Now, class, I'm going to have to give you the cash figure here because I don't think you'll understand how they calculated the cash amount. So I'm going to try to keep this as simple as possible and tell you I'll give you that figure. Again, the reason that I'm going to give it to you and not show you the calculations behind this is because you're missing some information from previous chapters that have not been covered in either of the courses that you've taken so far. We will cover this amount in my summer class for ACC 122 if you are an accounting major. If you're not an accounting major, don't worry about it. You're okay. As long as you know that cash is a current asset, I'm happy with that. I'm going to give you the amount of cash. From our trial balance, the next thing that we've got is our accounts receivable. And something that they tell us, so it's real important that you read all the information here. But in the last paragraph of additional information, they are telling you that the balances of accounts receivable, all of your prepaid expenses, and accounts payable at the end of the year are not expected to differ significantly from the beginning balances. So what they're telling you is just to use the amounts that they gave you for your budgeted amounts. These amounts are given as beginning balances up here where it says on January 1st, these are the beginning balances. But because of that additional information, they're telling you that these balances are not going to be that much different from the ending balances. So just use these. These are budgeted amounts and they are projections for the future. And so they're not going to be right on the money anyway. So 23,800 is the amount that you would plug in for your accounts receivable, which is considered to be a current asset. Again, the amount is 23,800. For your inventories, which are also a part of your current assets, you might remember the inventories for a manufacturing type of business are direct materials inventory, your work in process inventory, and your finished goods inventory. From my drop down list, the only inventory account would be finished goods. Now, technically, class, I probably would have started with direct materials inventory because we always talk about it first as being one of the manufacturing costs. I don't know why Cengage did this, but this was the only one that you could choose from, and it be an inventory. So we're going to start with finished goods inventory. And just like with the accounts receivable and the prepaid expenses and the accounts payable, it tells you in here that your inventories are not going to be that different. Right here, where it says the quantities and the cost of the inventories at December 31st are expected to remain unchanged from the balances at the beginning of the year. So you're just basically plugging in the amounts. And so we want to look for our finished goods inventory, which is 16,900, and just plug that amount in. Our next type of inventory is going to be, I guess your work in process inventory would be a good one to do. Let me see if that's the right one that they wanted. They say it's okay. So let's look and see about our work in process inventory. It too is given the amount. Work in process is 4,200. And then we're going to look for our materials inventory. And your materials inventory is $6,400. And then what we're going to have to do is we're going to have to add each one of our inventory accounts together to get a total of our inventories. So we're going to take the 16,900. We're going to add to it 4,200 and 6,400. The total of our inventories is 27,500. The next type of current asset that we would have would be our prepaid expenses. And our prepaid expenses, our instructions tell us that they are not expected to differ significantly from the beginning balances. So our prepaid expenses, you're just picking up the amount that they give us, which is $600 in this case. Now we're ready to total our current assets. So I'm going to start with my cash, which was 106,660. We're going to add to it the accounts receivable of 23,800. We're going to add to that the total of our inventories of 27,500. And then we're going to add to that the prepaid expenses of 600. That'll give you a total asset of 158,560. For your property, plant, and equipment, look to see what the names of your accounts are. For property, plant, and equipment, we'll have plant and equipment that's combined together. And then right underneath that would be less the accumulated depreciation. Those are your account titles. Now let's see what the amount for plant equipment is going to be. I'm looking through my additional information. On the very last line here, it's important for you to know that it is anticipated that fixed assets will be purchased for $22,000 cash in the month of May. So what they're doing is they're going to have to add $22,000 to the original amount of the plant and equipment cost. So the plant and equipment cost us originally $82,000, but we are expecting to buy $22,000 more of our equipment, which will give us a total of the plant and equipment at $104,000. So they made you read the additional information to see how much was purchased during this year. And so the total amount of the plant and equipment is $104,000. That's the cost. From that, we're going to subtract the accumulated depreciation. Remember that your accumulated depreciation will include all the depreciation expense for this period of time. So what they did is they gave you the beginning balance of accumulated depreciation, which is $32,000. So I'm going to put that in my calculator. That's your beginning balance is $32,000. To that, we're going to have to add any depreciation expense that we have incurred for this period of time. Notice under your factory overhead that was given to you, you had some depreciation of $4,000. When you make the adjusting entry for depreciation, you debt depreciation expense and you credit accumulated depreciation. So this 4,000 has to be added to the beginning balance of your accumulated depreciation to get your total accumulated depreciation of 36,000. So the accumulated depreciation would be the beginning balance of the accumulated depreciation plus the depreciation expense that was given to you under the factory overhead. Then you're going to take your accumulated depreciation and subtract it from the cost of your plant and equipment. That will give you the book value of this equipment, plant and equipment. So 104,000 104,000 minus 36,000 will give you 68,000. And so once we have the total of our property, plant, and equipment, we're going to add that to the total current assets, and that will give us the total assets. So this is how you do or you complete the asset section of the balance sheet. Do I have any questions about anything that we've got here? The next section is to compute your liabilities. We only have one liability, that's accounts payable at $14,800. The reason it's $14,800 is because our instructions tell us that the accounts payable at the end of the year is not expected to differ significantly from the beginning balances. So we just had to plug that amount in. The last section of a corporation's balance sheet has to do with what we call stockholders' equity. Now, in a corporation, stockholders own our company. And so that's why we're calling this stockholders' equity. The stockholders' equity you may not be that familiar with because, again, we're going to cover that in a future course. What I will say of the stockholders' equity is that it will be made up of stock accounts. Stock accounts are stock that an investor has bought in our business. And some of the stock accounts, we call them common stock. And so common stock will be listed as a part of stockholders' equity. Now look to your additional information to see what the amount of the common stock is going to be. There's no additional information that I'm reading about common stock, so I'm just going to pick up the amount of the common stock, which is 30,000, and I'm going to put it in the box. So just put the amount down that they give you. The second part of the stockholders' equity will be for something we call retained earnings. Again, I don't expect you to know how to calculate retained earnings. The amount for the retained earnings is $181,760. For your homework problem, I have given you that in a previous announcement on Blackboard. So go back and look at the announcements to get your retained earnings figure. And I don't know if I gave you the common stock figure or not, but that's the one that just is given. But I did give you the cash amount. So go back and look at your previous announcements for that. To find the total stockholders' equity, we're going to add the common stock and the retained earnings together. And that will give you 211,760. The last line is for you to total your liabilities and your stockholders' equity. The total of our liabilities was 14,800. And we're going to add this to our total stockholders' equity. So these two are added together to get 226,560. Notice that your total asset amount of 226,560 has to balance with the total liabilities and stockholders' equity. So these two amounts are the same. Is there any question about what I've done on the balance sheet? So that would wrap it up for the demonstration of Chapter 22's homework problems. Your homework problems, you'll remember I extended the due date. I believe I extended it twice now, but it's going to be Friday, April the 3rd, which is tomorrow, will be the due date for these homework problems. Your test is going to be due on Saturday, and next week we will start chapter 23, and I may have to push back your assignments for chapter 23, but I will tell you about those as we see what we can get through next week. So we'll do the best that we can. Next week, we're going to start a brand new chapter. And so if there are no questions, I will see you again next Tuesday. I don't hear any questions, so I'm going to stop sharing and I'm going to stop the recording.